From hard days selling chewing gum as a kid and buying first stock at 11 years old, after years of investing, he became one of the richest and most respected investors in history. This is the story how Warren Buffett got rich. Warren Buffett was born on August 30th, 1930, in Omaha, Nebraska. Warren was the second of the three children and the only son. His father, Howard Buffett, worked as a stockbroker and later served as a U.S. congressman, and his mother, Layla Buffett, was a housewife. At 6 years old, Warren started to buy chewing gum from his grandfather's grocery store and began door-to-door selling chewing gum to make small profits. Later, Warren started selling Coca-Cola bottles too. All this taught Warren about pricing, face-to-face sales, and keeping track of small profits. When Warren was around 7 years old, he found a book at the library called 1,000 Ways to Make $1,000. It deeply inspired him. Also, when Warren was 7 years old, his father ran a small brokerage. Warren visited often and read stocks tables, watched price boards being updated, asked a lot of questions, and listened to investors talking. At 11 years old, Warren made his first stock invest and bought 3 shares of Citi Service stock, each costing $38. The stock immediately fell to $27. Warren was terrified, but he stayed patient. When the stock rose back to $40, he sold all fast to protect the small profit. Months later, the stock jumped to over $200. Now Warren had learned a lesson: to not sell just because a stock goes up a little. When Warren was 12 years old, his father was elected to Congress. So Warren's family moved to Washington, D.C. There, Warren started Alice Steele Junior High School and later Woodrow Wilson High School. At 13 years old, Warren became a paperboy, delivering the Washington Post and other newspapers. He delivered hundreds of paper daily and built a consistent route. At this time, Warren filed a U.S. income tax return, reporting income from his paper route. He kept expanding his business, and at age of 14, Warren was selling newspapers, stamps, golf balls which he collected around golf courses. He was also washing cars and detailing them. Also, he was running a small delivery business. He made around $6 a day, which means around $110 in today's money. Same year, Warren and his friend Don Danley bought a used pinball machine for $25. They placed it in a barber shop and they made money immediately. Within months, they used profits to buy more machines. They expanded to several shops across Washington. Eventually, they sold the small company for $1,200, which means $21,000 in today's money. It was a huge amount for two 15 years old. Warren had learned how to manage employees and scale a business. Now, by age of 15, Warren had saved about $2,000, which means $36,000 on today's money. Warren decided to buy 40 acres of farmland from Nebraska. It was managed by a tenant farmer. This was his first real investment in an asset that produced regular income. Warren continued all his businesses and finished high school in 1947 at age of 17. Warren continued studying and went to college. He studied economics and graduated with Bachelor of Science in Business Administration in 1950 at age of 19. After that, Warren attended for Columbia Business School in New York. He studied under Benjamin Graham, an author of The Intelligent Investor, who became Warren's mentor. Warren graduated in 1951 at age of 20 with a master's in economics. Now, from school, Warren had learned value investing, which means buying undervalued companies, focusing on intrinsic value, and holding for the long term. So Warren started working at Graham Newman Corp., Benjamin Graham's investment firm, where he studied and learned stock analysis, corporate valuation, investment discipline, cash flows, and margin of safety. Warren also tried several other jobs in investing and brokerage in New York, but returned to Omaha to start his own investment firm in 1956. At the age of 25, Warren found Buffett Partnership Limited with $105,000 of capital from 7 family members and friends. The company was structured as a limited partnership. Warren was the general partner, which meant he managed all investments and made all decisions. Family members and friends was the investors that were limited partners. They only put up the capital and didn't make any management decisions. Warren earned 20% of the profits as a performance fee. Buffett's partnerships were highly successful. Early returns were 20 to 30% annually for investors, far higher than the market average. By the early 1960s, Warren saw a company named Berkshire Hathaway struggling in textile business. The business were facing declining demand, rising costs, and inefficient operations. Warren didn't invest it on it yet. Time went by, and in 1962, Warren made his own first million through Buffett Partnership Limited. Also in 1962, Warren noticed that Berkshire Hathaway stock was undervalued. It was trading below its book value. Warren saw it as a cheap company that had few valuable things left. So there was a chance to make money. Warren began buying shares. The price was around $7.50 per share at the time. Warren acquired enough shares to have influence in the company, but he didn't fully control it yet. At one point, CEO of the company named Seabury Stanton was mismanaging the company. So Warren made a tender offer to buy more shares from other shareholders at $11.50 per share. Seabury Stanton refused to sell Warren the shares he wanted. But in 1965, Warren purchased a controlling stake from shareholders and took the control of Berkshire Hathaway and became the CEO. Warren paid around $11.50 per share and a total of around $7 million, which means around $72 million in today's money. A lot of the money came from Warren's investment company. Few months after buying, Warren realized, even with good management, the textile business required constant capital investment and only produced very low or negative returns and faced relentless foreign competition. Warren now had understood textiles were not just temporarily weak, they were structurally bad. He had made a serious mistake. Warren had two options: either shut down the business or keep it running, trying to generate cash. He chose to try generate cash and started to buy insurance companies and other profitable businesses. Later, Warren started to shift Berkshire Hathaway entirely away from textiles and started to change it to an investment and holding company. In 1967 happened a turning point. Berkshire Hathaway bought National Indemnity and National Fire and Marine. They were insurance companies, specifically property and casualty insurers. They covered things like car insurance, trucking insurance, commercial liability, fire damage, and business property losses. This gave Berkshire Hathaway an insurance float, so the money flow was so big, the money they held temporarily was investable. This changed everything. Berkshire Hathaway now had large amounts of capital, which cost little, and Warren invested for long term. Around 1970, Warren had gained net worth of around $10 million, which means $85 million in today's money. In 1972, Warren realized a great business beats a cheap business, and compounding matters more than bargain prices. He stopped trying to turn around bad businesses and stopped trying to fix bad economics. Warren started to focus on excellent businesses. So in 1972, Warren's company Berkshire Hathaway bought See's Candies, a huge premium chocolate and candy company. He paid $25 million for it. Warren bought the company because he realized it had a strong brand, pricing power, high returns on capital, and minimal reinvestment needs. See's Candies continued to expand retail presence gradually and started to innovate in seasonal offerings like Valentine's and Christmas. It also started to focus on customer experience. Warren invested money in different places, and in the 1970s, his major investments were the Washington Post Company, American Express, and insurance expansion. Also, Warren had invested in Geico at 1976, and by 1980, the stock had grown a lot, which created a lot of free cash flow for Berkshire Hathaway. By 1980, Warren had gathered net worth around $100 million, which would mean $400 million in today's money. In 1985, Warren accepted the full mistake of textiles and shut down the textile business after 20 years of losses and capital drain. By 1986, Warren had become billionaire with net worth of $1 billion. In 1987, Warren bought about $1 billion worth of Coca-Cola stock after the 1987 market crash. Also in 1980, Berkshire Hathaway began acquiring whole companies outside of insurance and candy like local newspapers, manufacturing businesses with strong returns on capital, and utilities and energy companies. By the 1990s, Coca-Cola accounted for a large portion of Berkshire Hathaway's stock portfolio. Warren held Coca-Cola for its global brand, pricing power, and predictability. 1996, Berkshire Hathaway acquired 100% of Geico. It gave a huge free cash flow to invest. Warren kept doing same things and kept same investments for decades, and by 2005, Berkshire Hathaway's market value surpassed $100 billion. Warren have keep his strategy mostly the same to this day. He's only investing in already working companies. From selling candy and investing as a child, lot of studying and hard work, Warren Buffett became billionaire in decades. The lesson is to keep working always and became better through mistakes. This was the story of how Warren Buffett got rich. I hope you subscribe and like the video. Thank you for watching.